Hello everyone, this is Richard Chen with BeaterFree.com, here to provide you with an investing basics overview. This will be the first of a series of 5 seminars, 1-hour seminars, and each video will be 30 minutes so that we can kind of give you a little break during the individual seminars. So the first seminar, as you can see here, will be an overview of investing, and then this will be the first of 5 parts. So the other 4 parts will go over in detail what we go over in the first part in the overview. So first of all, before I start, let me introduce to you my investing partner, Mr. Warren Buffett. He is not here in person, obviously, but he is here in spirit and investing philosophy. And I do have, I'm a Berkshire Hathaway shareholder. So it is official. We are investing partners. And much of Mr. Buffett's philosophy of value investing will be in view throughout this seminar. So first, let us start on question number 1. Why invest? Certainly this is a very subjective question, and it could vary differently depending on who you are and where you are in life and how you came upon investing. I could certainly share 3 reasons, and it will actually be interesting to talk about how we rank those reasons, and obviously I might view it a little bit differently. So the first one, and I would like to explain in that order, why invest, is actually to understand business. And I'll talk a little bit about that. And when I say understand business, it means it can be from the perspective of someone who works at a job at a corporation. It could be from the perspective of an entrepreneur, or as a perspective of an investor. So 3 different perspectives. Investing helps you understand all 3 different perspectives. In investing, when you try to analyze a company's short-term and long-term prospects, whether as an employee of the company, as an entrepreneur, or as an investor, it does benefit to understand whether the company can withstand a long-term competition. Obviously, whether to keep your job or to grow your business or to grow your portfolio. So to invest involves, in my experience, first priority is to really understand businesses, how they work, how they compete, how they grow, and how they go through the various stages of the business life cycle. So that to me is actually the first reason to invest. And regardless of how you make your money, you do have, in my opinion, a reason to learn investing. So the second is probably what a number of people may say is the first priority, is to understand or take control of your financial future. Okay, and that's pretty clear, right? So you want to be able to learn how to invest, whether you invest for yourself. The 3 main ways you invest for yourself: you just invest in index funds, or you have a portfolio manager. And regardless how you approach it, you could try a balanced approach, and it's certainly okay to do that. But it is important to understand what actually is going on, regardless of whether you're doing it yourself, you're having the indexing companies do it for you, or you have a portfolio manager. So that's pretty straightforward. And then the third one, again, it may or may not go for everybody, and certainly in my case, because I do enjoy it very much, is I like to consider it as a money-making hobby. And one of the reasons people talk about Warren Buffett, why he's so successful, is certainly he has obviously a talent and spends a lot of time, but he actually, just like you may have heard this before in motivational seminars, you find something you actually enjoy and you'll be very good at it because you don't see it as work, and you can do it around the clock or when you can't sleep. And then you enjoy it, so you go into this flow, this zone, and you're happy and you're very successful. So just think of it as a hobby where you can make money. Okay. So those are reasons to consider investing. And I forgot to say hello to everybody. So let me see if I can do. Oh, I sent the reverse button. Here, I'll just go ahead and say hi to everybody here. Oh, and I have my reverse button. Hi. Okay. So when I find my reverse button, I'll be a lot easier. You probably see a little bit more of me. So let's start with popular asset classes in investing. And of course, everyone has some familiarity with stocks and bonds. And so let's talk about, here's a nice little exercise, fill in the blanks, what you're used to doing at school. And so filling in the blanks will help us comprehend. So you can download this sheet, and if you want to fill it out at beatofree.com website for under education. So let's talk about stocks, and one of the best ways is to look at the two different types of stocks. So you have common and preferred. Okay, so common stocks is often what you hear about in the news a lot. So, and is by majority what most people invest in. But it is nice to compare it to preferred stocks, so you have some basis for understanding. And let me first start off by saying the reason why stocks are even issued as publicly traded companies is that the company may at that point or in the past or in the future have need for capital. They need cash to grow and hopefully not to fund operations, but mostly to grow. Otherwise, the company would just stay private. And many companies, successful companies, do. So stock is issued, is sold to the public initially as what we call an IPO, which we talk about here. We'll talk. And that's usually the biggest offering, usually, not always. And then it has subsequent offerings where if it needs more cash, then it sells more stock. Okay, so often that is common stock that's offered available. Preferred stock, by comparison, well, we can talk about what it means to be priority. It means that the company's assets, if it were to be, the company's assets, if it were to be liquidated, or even a company's payout in the form of a dividend distribution, has different levels of priority depending on whether you own common or preferred stock. And a lot of people probably don't know that, and certainly a lot of companies don't even have preferred stock. It's mostly offered by banks, and you can look that up pretty easily on the web. And the preferred stock have their own notations and stuff. So priority really means where do the company's assets go, whether it's day-to-day payouts and distribution dividend, or in the unfortunate event of a bankruptcy, where the assets are first, who has first right access. And so let me talk about here so you can have a better understanding. So preferred stocks have a higher priority on a company's assets than common stocks. Excuse me. But lower than, you might have guessed it, bonds. Okay, so you can think the bond holders actually have, bond holders get their interest payments from the company's cash flows, and if the company would be liquidated, and the bond holders also get their principal repaid right away. Okay, so that's something for reference, and then we can talk first about what we call an IPO price, which is very interesting and helps you understand common stocks a little better in comparison to their counterparts of preferred stocks. So the common stock IPO price is basically based on the market. So that's why when you had back in 2000 the dot-com boom, the very a lot of these companies had what you heard, if you're old enough, these sky-high valuations, and that's because there was really no benchmark. There's really nothing to reference, and people it was basically supply and demand. And people wanted to pay that price, and were asking that price, and that was the price. And that's probably why it led to a lot of money, well, being made and lost at the same time. Mostly losses. Well, at least in terms of the number of individuals, mostly money lost. Individuals lost money. And then for preferred, it's constant, which is very interesting. It's constant at $25. So why $25? I don't know. It's probably an arbitrary number, but you'll see the IPO of a preferred stock is always going to be $25. It's what we call par. Okay. Tenure ownership, common stock, in theory, can be owned forever. Basically, forever so long as the company exists. Okay, and then the tenure ownership of preferred stock is that it can be, but is not necessarily recalled after a call date. Okay, so call date is simply just another date on which the company recalls or redeems. It just basically takes back the bond, and they'll pay the bondholder the IPO price at $25. So you can see often the common stocks, preferred stocks, they do fluctuate a little bit, and we'll go into that actually right here. The volatility in terms of the range of the price, how high or low it gets, is much higher for common stocks than preferred stock. I mean, literally, it could be from 0 to, as you know, more than 1,000, or like in case of Google, Apple, or Priceline. So it's really arbitrary depending on whether the company splits its shares. And most people don't pay attention to share counts. That's why they think $1,000 stock is necessarily worth more than $100 stock or $50 stock. But it's more the market capital that you have to look at to see the company's actual valuation, not the per share price. So by comparison, preferred stocks has much lower volatility. And literally, I mean, you can look at a lot of pricing. If it's 25, I mean, usually it might be plus or minus $2 or $3 from the IPO price. So it could be like in the 20s, high 20s or low 20s. That's pretty much, unless there's some, and that's because again, it's a stable source of dividend income, and it's really not affected by, there's low volume. And there's certainly a lot of factors, we can go into that, but in general, prefers have much lower volatility, and they have, actually probably mentioned here, dividend payout. Preferred stocks usually have much higher dividend payout, maybe anywhere from 3 to 5%, and whereas common stocks lower, usually between 1 and 3%. Okay, so that's a good segue into bonds. So you can kind of see here, preferred stocks. We can actually have more indications to that fact. The preferred stocks have similar properties. They're kind of in between. So preferred stocks are kind of in between common stocks and bonds in terms of the properties, and we'll go more into that when we talk about properties of bonds. So first, obviously, the bonds. What makes bonds more attractive than stocks is that there's not as much fluctuation in price. So there's not as much upside or downside, not as much risk. Bonds have higher priority. Bondholders have higher priority to a company's cash from operations, operating cash flow, as well as, again, in the event of a bankruptcy, its assets. And so an important aspect of a bond is looking at its financial strength. And as you can see, there are three types of bonds, three major types of bonds. There's corporate bonds, company bonds, government bonds, and then by government, again, the municipal bonds, but when you say actually it should probably be U.S. government bonds. But U.S. Oh, excuse me. Okay. So the financial strength of a corporate can really vary, but in general, it's generally low. We can say that lower. Or you can say low to medium. I mean, so there are some companies that are very sound. bonds, for example, ExxonMobil, or I mean, of course, this could always change in a few years, but ExxonMobil, Microsoft, Johnson and Johnson, companies that are rated. We can go into that a little bit later. Triple A by Standard & Poor's or Moody's, the credit rating agencies. So low to medium by comparison. Now, munis are high, right? And looking at since municipal bonds were rated in 1970, so now you're looking at almost 50 years. There's only been a handful of defaults on municipal bonds. And you're talking about thousands of bonds, just a handful, probably a few dozen or something like that. Okay, so very low risk of bond defaulting. So financial strength of municipal bond, sorry, I'm just going to stick with financial strength here. And interesting enough, you may have some people who may argue otherwise or interpret otherwise. The U.S. government bonds, meaning treasuries, right, is basically highest. I venture to say that highest globally. So they actually, the U.S. Treasury actually bought by foreign governments as because of this, the faith and the strength of the U.S. dollar, and obviously the U.S. has the ability to print with this print, and of course we do it with discretion, and that's part of the faith, as to print the money that we need to satisfy the application. So the U.S. government borrows money, you could always print it, pay it back. So it's kind of like the left and the right arm playing and helping each other out, left pocket and right pocket. So it is the highest globally, by all means, in perspectives. And so the yield, which is interesting, and you should know this, and it's intuitive, and that's a very important concept. Usually, if an asset's financial strength is inversely correlated to the yield, meaning if it has a lot of strength, financial strength to be able to pay it, then it can actually command a lower yield, which kind of makes sense if you think about it. That's kind of like saying, if you think about when you apply for a mortgage, if you have a good credit rating, you pay a low mortgage. It's the same idea, right? So entities, whether it's a person or a company with financial strength, expect to pay lower interest rates, which makes sense, right? Because you want to get rewarded, and you're what they call a good risk. Good risk is it gets to earn the right to pay lower interest rates, which makes sense. Like if you're responsible, then people ask less of you and stuff like that because they know you're good. The chance of default is low. So corporate yields are relatively high in terms of the bond lineup. Okay, and this is all related, by the way, because the financial strength, in large degree and in part, is affected by the guarantor. In other words, even if the bond defaults, meaning that its usual operations where it takes revenue, we'll talk about that when it gets income from those operations and pays out the interest, if that ever not work, and then, income from operations, if ideally that should be good, but if that doesn't work, the company starts losing money, then the next resource it has, or an entity so that is its cash reserve, right? So it draws from its reserve in cash. Hopefully it has some or a lot. And then if that fails, then you have to basically look at a guarantor. And it's basically someone who is usually not a part of the entity. In this case, as corporate company assets is actually in that case, is inside account. But in these other two cases, you have to have an entity, an outside entity, basically guarantee. And the U.S. government, U.S. Treasury, I guess it is kind of the same thing. I think probably the most interesting case here is with municipal bonds, where basically a city, it has its budget or its income, and then it has its expenses, and usually it can balance it. If it can't balance them, then it goes to its cash reserve, internal cash reserve, and that's exhausted. Then you have to look at guarantors for the municipality. So interesting enough, the cities are backed by the states and, in theory, U.S. government. And when I mentioned the other cases where the municipalities defaulting, and of course, U.S. government has never defaulted. So in theory, there's not even a full, long, drawn-out default when those municipalities you're defaulting. Just trying to find a good. I'll find that later. Bond credit rating. Okay, so I'll be right back when we get into bonds. Okay, so that's what you have. Basic introductory to types of stocks and bonds. And I want to talk a little bit about, let's see here, let's save financial metrics, financial statements for the next part. So let's do a little bit of synthesis and talk about stocks and bonds because they are part of almost every portfolio, and you know they complement each other, and it's good to talk a little bit about how they balance each other, and how you decide what percentage of your portfolio should go into stocks and bonds. And again, this is really not a money management discussion. You can just some basic overview how people can approach it, and things you consider or dimensions of consideration should be first of all your need for income, right? So stocks can pay dividends, which is an income. Bonds pay interest, depending on what. Certainly, some stocks, a lot of growth companies, smaller companies, growth companies, don't pay a dividend. So you just sit there and you're just waiting for basically the stock to appreciate and you can sell later. So there's no guaranteed income for stocks. Obviously, with bonds, there is guaranteed income. And again, we talked about depending on your tolerance for risk. If you want to have within the bond spectrum, you tolerate higher risk. Let's say a corporate bond, you could get higher yields. So you can talk about anywhere from 4 to 5%. Some higher risk companies 7%, depending on tolerance. Treasuries. I can look a little bit later. I mean, depending on, again, your time frame is actually important. If you want to do a 30-year bond, I think the rate's probably around 3%. If it's a 1-year bond, I don't want to give out numbers that are not accurate. But anyway, it could be anywhere from 1 to 3% U.S. government bonds. Municipals are similar, maybe a little bit higher. In some cases, if you want to do a leveraged bond where short-term money is borrowed to invest in higher, longer-term money, which is a lot of the number of companies do, you can get higher yields above 5%. And of course, so if you need income, if you're not working, then obviously bonds are a larger portion of your portfolio. And depending on your tax bracket, whether to do just bonds, U.S. government bonds, like treasuries or municipals, because you don't pay taxes on municipal bonds, which is the wonderful thing, and you do pay on U.S. government bonds. So that's an interesting highlight there. And so, and pricing correlation, so it's very interesting. So often people use stocks and bonds to kind of balance each other out. So if they usually sell the bonds and they buy the stocks, because depending on where the market's going and their changes in their life needs. And as you know, pricing is affected by activity, so demand, right? So if the overall market sells a bunch of bonds, they usually exit, not always, but they usually exit the bonds and enter into stocks. So usually the prices, not, but obviously if they sell one asset and to buy another, the price of the first asset goes down, the price of the second asset goes up, right? So that's why there's a little bit of complementation in terms of pricing between bonds and stocks. Okay, so we have about 5 minutes, and you've been staring at the screen, so I have 5 minutes, so I'll show you a few electronic and physical resources. Let's start with probably the physical resources. So for your own education, I have 5 books here that I recommend. So the first one is what my friend Mr. Buffett recommends as the Bible investing. He said it's the greatest book on investing ever written. When I read it, and I still think it is, it's written by Benjamin Graham, who was Warren Buffett's mentor. So it's called The Intelligent Investor. Definitive Book of Value Investing. By far the best book on investing ever written. Warren E. Buffett. It's written by Benjamin Graham. It's very easy to get from Amazon. The second author that Warren Buffett recommends is Philip Fisher, Common Stocks and Uncommon Profits. I'm an eager reader of what Phil has to say. I recommend it to you. Phil Fisher is actually the father of Ken Fisher, who is the famous money manager. Actually, speaking of Ken Fisher, let's look at Mr. Fisher. He provides this great book, and you like to be visual. This is visual. It's called Wall Street Waltz, Visual Perspective. He's talking about, he's got wonderful data, spans over 100 years. Let me show you some of these. And he's got like almost 100 charts. Here's a nice graph, long-term time between earnings and stocks, right? And that's a wonderful analysis going to look at earnings and stocks. For those of you that wonder why stock prices go up irrationally, and whether you feel like you should invest in them, depending, earnings are obviously very important. Here's another one. This is looking at yield and the S&P 500 and yield on high-grade corporate bonds. So it's interesting. Now this is actually a very good example where you're comparing the S&P earnings. It's actually the earnings yield and then the bond yield, which is interesting. Looking at how prices of bonds and stocks correlate, and of course the earnings yield is a factor on stock prices. So this is just let me see if I can find some other interesting, but this is great. I mean, we only got like 2 minutes. Let me see if I can find anything really cool. I mean, they got all sorts. These are, let's see, how many charts do they have? Ooh, 83 charts. Oh, it's just wonderful. I mean, this is, defense budget as a percentage of GNP. I mean, there's all these other factors you could look at. Looking at, it's not only about stocks, but it could be about, general great financial education themselves. This annual rates of return on common stock, 1925, 1976. Some of the stuff we talked about, dividends and this is great. Look at that. Lots for the data freak in you. Okay. So we got that, and then, I got about 2 minutes. Oh, and then of course, on Oracle himself, there's actually a public compilation of all Berkshire Hathaway letters to shareholders, 1965, 2012. I think there was another one that was updated from 2014. Again, excellent. They're written without necessarily, need to, for a reasonably well-educated reader, and it goes back all these years. I've read it over probably like 3 to 5 times. Excellent course on investing. I think the other two I was going to show you, this is more I like about this book, What Works on Wall Street by James P. O'Shaughnessy. It is a nice compilation of financial history along with data, as well as a little bit of strategy. So let's just say a third, okay? And it's just very interesting whether you're like an economic historian, you're an investor, provides a nice balance. Some data, some history, some strategy, not too much of any of one to really bore you or to have you too focused. And then, so I have 20 seconds. Well, it might go over a little bit, my time limit a little bit. And I want to show you electronic research. Oh, I may not have time, but let's break now, and we'll do it the electronic research that I have. Okay, we will see you in a little bit. Thank you.